We have decisively crossed into uncharted territory. For an extended period, we have consistently voiced concerns that the silver market was fundamentally flawed. We have repeatedly highlighted the artificial nature of its suppression. Our warnings indicated that when the inevitable breakdown occurred, the resulting surge would not be a gentle flow, but a catastrophic deluge. Today, Saturday, December 27th, the dam has not merely fractured, it has utterly disintegrated. Examine the closing figures from the electronic trading session. Silver is currently trading at $79.25. This represents an increase of $7.34 within a single trading day. That is a monumental gain of 10.21%. To be absolutely explicit, commodities do not experience 10% price swings on a daily basis under typical market conditions. A 10% movement is not a mere rally. It signifies a liquidation event. It is, in essence, a crime scene. What we have just witnessed is the demise of a major financial entity. Somewhere across the globe, a colossal short seller has just imploded. They were compelled to repurchase every single contract they held at prevailing market prices. The cost was irrelevant. Charts were disregarded. They simply hammered the buy button until their account balance reached zero. And because this unfolded during Ghost Week, the period of lowest liquidity in the entire year, there was virtually no one available to sell to them. The price experienced a vertical ascent. We now stand on the precipice of $80. In this urgent market update, we will meticulously examine the mechanics of a market melt-up. We will delve into the price of gold at $4,534 and explain how this powerfully demonstrates the ongoing collapse of the US dollar in real time. Furthermore, we will equip you with the necessary preparation for Monday morning, as if silver concludes the week at $79, the Sunday market open will likely trigger a circuit breaker, effectively freezing the entirety of the global exchange. The established order has been disrupted, the system is irrevocably broken, and the widespread panic is only just beginning to manifest. To truly comprehend the sheer force of a 10% price surge, one must grasp the underlying dynamics of forced buying. In a conventional market, buyers and sellers engage in negotiation. I aim to acquire at $75. You wish to divest at $76. We find common ground. However, during a liquidation event, negotiation ceases. The clearinghouse assumes control of the bankrupt fund's trading terminal. The algorithm is programmed with a singular objective: liquidate all positions immediately. The prevailing price, whether it be 75, 79, or even 100, is inconsequential. It simply executes purchases, absorbing the entire order book. This morning, we observed a vertical line on the trading chart. This line quantifies the market impact of a significant player's downfall. The trading volume was immense and the speed of execution was instantaneous. This confirms that the risk of a short squeeze has transitioned from a theoretical concern to a systemic reality. The dominoes are now falling in rapid succession. Initially, it was individual retail short sellers who succumbed, followed by family offices. Now it is institutional funds. The next entities to face consequences will likely be the bullion banks themselves. When you witness a 10% price increase in silver, you are observing a fundamental repricing of the global monetary system. This extends far beyond simple supply and demand dynamics for a precious metal. It signifies a profound erosion of confidence in the currency used to denominate that metal's value. Investors are scrutinizing the US dollar and making a clear decision: divest immediately. Divest at any cost. Now, let us consider the broader context. Gold, the elder statesman of precious metals, typically leads such movements. Gold is presently trading at $4,534, showing an increase of over 1% for the day. This represents a historic breakout. The $4,500 level was previously deemed an impossible target by many economists, a figure associated with doomsday scenarios. Well, doomsday has arrived. The fact that gold is firmly holding above $4,500 validates the significant movement we are seeing in silver. If gold is valued at $4,500 and the historical gold to silver ratio typically hovers around 15 to 1, then silver should logically be trading at $300. At its current price of $79, silver remains mathematically undervalued. It is lagging behind, attempting to catch up. This catch-up trade possesses considerable momentum. Algorithms are observing gold at its all-time highs. They then turn their attention to silver, noting that it is still 50% below its inflation-adjusted peak, prompting them to initiate purchases. They are acquiring billions of dollars worth of silver because it represents the sole remaining asset that has not yet fully adjusted to the prevailing inflationary environment. Therefore, do not be intimidated by the steepness of the price chart. It appears alarming because we are unaccustomed to such movements. We have grown accustomed to market suppression and gradual grinding price increases. However, liberation is often a messy affair. And at this very moment, the price of silver is breaking free. We must address the inherent risks associated with the weekend. It is currently Saturday, and the financial markets are officially closed. The price of silver is fixed on screens at $79.25. Nevertheless, the news cycle is actively churning. Headlines are beginning to emerge concerning bank insolvencies and the failures of hedge funds. Whispers are circulating regarding a potential settlement default in London. This creates a potent psychological pressure cooker for anyone who does not possess physical metal. If your holdings are in paper form, you are undoubtedly experiencing significant apprehension, questioning whether the exchange will even open on Sunday and if your brokerage firm will remain solvent come Monday. This palpable fear compels capital to exit the broader financial system and seek refuge in the physical market. We are receiving reports indicating that online bullion dealers have completely removed their inventory from public view, citing site maintenance, sold-out status, or requiring direct contact for pricing inquiries. These are clear indicators of a breakdown in the physical market. They are unable to establish prices for the metal because its value is escalating at a pace exceeding the capabilities of their software. If you attempted to purchase a silver coin today, you might find yourself paying upwards of $100. The spot price of $79 is already largely irrelevant. The price at the street level has already surpassed the triple-digit threshold. This divergence between the frozen digital price and the urgent demand in the physical market is the very definition of a currency crisis. When individuals are unable to acquire goods at the officially stated price, it signals the failure of that currency. We are presently witnessing a pivotal historical turning point. The global realization is dawning that paper assurances hold no value when the vaults are empty. Let us now analyze the possibility of a limit-up scenario unfolding on Sunday night. The CME Group adheres to a strict set of rules, commonly referred to as circuit breakers. If the price of silver increases by a predefined dollar amount within a single trading session, the exchange is mandated to halt all trading activity. This effectively freezes the market, preventing any transactions from occurring. No buying, no selling. The trading screens simply stop updating. Given that silver closed at $79.25, a substantial gap up in price on Sunday night would almost certainly trigger the limit-up threshold, leading to an immediate trading halt. What is the consequence of such an event? Unadulterated panic. Imagine the predicament of a short seller. They are incurring millions in losses. Their immediate instinct is to buy and cover their positions to mitigate further damage, but the system declares a market halt. They are trapped within a burning building with locked exits. They must await the market's reopening, and upon its reopening, it gaps up once more. This is precisely how a market can become locked at its limit-up level. Such a freeze can persist for several days. We observed a similar phenomenon in the nickel market in 2022 and previously in the lumber market. Now, this scenario is unfolding with silver. If you witness the market halted on Sunday night, remain calm. Do not initiate frantic calls to your broker. This development signifies your success. It indicates that the demand is so overwhelming that the operational capacity of the exchange infrastructure cannot cope. It serves as the ultimate validation of our investment thesis. However, it is imperative to be prepared for the extreme volatility that will inevitably follow once the trading limits are expanded and the market eventually reopens. The process of price discovery will be exceptionally turbulent. We could witness silver trading within a $10 range in the span of a single hour. This is not a market conducive to leverage trading. This is a market that demands outright ownership. Let us revisit the January effect, a concept we have discussed previously, but the context has dramatically shifted. Funds that had earmarked purchases for January are now observing silver at $79.25 and are experiencing considerable alarm. They recognize that they have procrastinated for too long. The opportunity to enter at $70 has passed. The chance to acquire at $75 is also gone. They are now faced with a critical decision. Do they pursue the asset at $80 or do they wait? Historical precedent suggests they will chase the price. Institutional investors are inherently momentum-driven. They tend to buy at higher levels to capitalize on further price appreciation. The fact that silver has already surged by 10% in a single day paradoxically makes it more attractive to them, not less. It signals potential alpha and superior performance. Consequently, on January 2nd, we anticipate a substantial influx of capital entering a market that is already severely strained. This 10% daily gain is merely the precursor to the main event. The true earthquake will occur when the pension funds begin their entry. We are positioning ourselves for a price movement that could propel silver to $100 by mid-January. However, we must maintain a realistic perspective. No asset can ascend in a straight line indefinitely without periodic corrections. A 10% daily price increase is typically followed by significant turbulence. We may experience a wave of profit-taking. Traders who acquired silver at $65 are currently holding substantial unrealized gains. They might choose to sell to secure these profits. This could lead to a sharp retracement back to $75. Such a pullback would be considered normal and indeed healthy. Do not allow a temporary decline to dislodge you from your position. In a vertically trending market, a $5 decrease represents merely a dip, a potential buying opportunity for the larger players who may have missed the initial breakout. The overarching trend remains upward. Supply is virtually non-existent. The major financial institutions are facing collapse. Any dip in price should be viewed as a gift. Now let us consider the potential for black swan events. When a market experiences a 10% surge within a single day without a readily apparent news catalyst, it typically signifies that the underlying news is imminent. The market, in essence, anticipates the impending developments. Someone possesses insider knowledge. Could it be a bank failure? A geopolitical escalation? A new export ban imposed by China? We do not have definitive answers yet, but the price action strongly suggests a negative development. This represents information asymmetry. Insiders are likely accumulating positions because they are privy to information that has not yet been publicly disclosed. By the time you read the relevant headline on Monday, the price may have already advanced to $85. This is precisely why one should trade based on price action, not on the news. The price action reflects the underlying truth, while the news often serves as a post hoc justification. So, what actions should you consider taking this weekend? Your primary objective is to maintain composure. You are a witness to history, observing the dismantling of a 40-year manipulation scheme. The process is inherently chaotic and noisy. However, you are strategically positioned on the correct side of this trade. Ensure the security of your holdings. Verify your storage arrangements. If you possess silver in an unallocated account, expedite its transfer to physical possession. If your silver is held within an ETF, meticulously review the prospectus. This weekend presents an opportune moment to conduct a thorough audit of your existing assets, because when the market reopens on Sunday, the era of chaos will truly begin. We will continue this in-depth analysis. It is essential to examine the bank insolvency aspect, which institutions have failed, which banks are teetering on the brink. Furthermore, we must investigate the phenomenon of industrial hoarding that is exacerbating the physical shortage. And we need to chart a clear path toward $100. The financial system has just experienced a critical failure, and silver represents the only viable escape route. We must identify the casualties. When an asset as significant as the silver market experiences a 10% price movement within a single day, it generates a considerable ripple effect. In futures trading, it is inherently a zero-sum game. For every market participant who profits, another must incur a loss. The long positions have generated billions in gains today, implying that the short positions have collectively lost billions. Who comprises these short sellers? They are not the typical retail traders, who are typically decimated by mere 50-cent price fluctuations. To absorb a $7 price swing and still remain solvent requires a balance sheet comparable in size to that of a sovereign nation. We are referring to systemically important financial institutions. We are talking about the major bullion banks. Over the weekend, rumors are circulating in financial centers like London and Singapore that a prominent clearing member of the exchange has failed to meet a margin call. This could be the Lehman Brothers moment for the commodities market. If a clearing member defaults, the exchange itself is compelled to intervene. Exchanges maintain a default fund to cover such events. However, if the magnitude of the losses becomes sufficiently large, if silver indeed reaches $100, that default fund could be depleted. Subsequently, other members of the exchange would be obligated to contribute to cover the shortfall. This is the essence of contagion. If Bank A collapses due to its exposure to silver, Banks B and C are subsequently forced to absorb a portion of that loss. This, in turn, weakens Banks B and C. They may then begin to recall their own loans. Liquidity will consequently dry up across the entire financial ecosystem. This explains the recent tremors observed in the bond market. The short position in silver is not an isolated trading activity. It represents a fundamental structural component of the global financial edifice, and that component has just catastrophically fractured. Therefore, on Monday morning, our focus will extend beyond simply observing the price of silver. We will be closely monitoring the repo market, scrutinizing interbank lending rates, and searching for any indications that banks are ceasing to trust one another. If they stop lending to each other due to uncertainty regarding which institutions are insolvent following the silver price spike, the entire credit system will grind to a halt. In such a scenario, the Federal Reserve would be compelled to intervene. How would they intervene? By printing more money, which would invariably further escalate the price of silver. This represents the ultimate predicament. To rescue the banks from the silver squeeze, they are forced to inject more currency into the system, thereby fueling the very silver squeeze they are attempting to contain. They are effectively pouring gasoline on the fire in an effort to extinguish it. Now let us shift our attention to the industrial sector's reaction. If you are the chief executive officer of a company like Samsung or Tesla, you have just witnessed a 10% surge in silver prices. Your cost of goods sold has consequently experienced a dramatic increase. More critically, however, you are likely gripped by profound anxiety regarding the availability of this essential metal. In a market exhibiting such rapid price appreciation, suppliers tend to vanish. Refiners cease responding to telephone inquiries. Mines halt shipments of the metal. Every participant is adopting a wait-and-see approach, observing the ultimate price level. This creates a significant supply shock. Industrial buyers typically operate under contractual agreements. For instance, a company might require 10,000 ounces on the first of each month, but these contracts often contain force majeure clauses. If the price movement becomes too extreme, the supplier reserves the right to cancel the contract. We strongly believe that suppliers are currently invoking these clauses. They are informing companies like Tesla that they are unable to fulfill deliveries at the previously agreed upon price, citing the market's instability. This forces companies like Tesla to enter the spot market, compelled to bid for physical metal in direct competition with investors. This has transformed into a battle for essential resources. A car manufacturer requires silver to produce vehicles. An investor seeks silver to preserve their accumulated wealth. Who will prevail? The party willing to offer the highest price. And at this juncture, the automotive manufacturers possess deeper financial reserves. This phenomenon of industrial panic buying is precisely what elevates a 10% daily gain to a 20% increase. These buyers are price inelastic. Their sole imperative is to secure the necessary metal. Let us now examine the physical dealer market. With silver trading at $79.25, the paper price is converging with the physical price. Typically, there exists a premium for physical metal. It commands a higher price than its paper equivalent. However, when the paper price experiences such a rapid surge, it can occasionally overshoot. This creates a chaotic environment where dealers struggle to accurately price their inventory of coins. I recently surveyed a major dealer's website. They have removed all pricing information for Silver Eagles, directing customers to call for price. The reason for this is the extreme volatility. Their automated pricing software cannot keep pace with the rapid fluctuations. If they were to set a price at $90 and silver subsequently gaps up to $95 in Asian trading, they would incur substantial losses. Consequently, they revert to manual pricing, which inherently slows down the velocity of sales and creates a bottleneck. Furthermore, this indicates that inventory levels are critically low. A dealer does not resort to call for price if their warehouses are overflowing with metal. This strategy is employed when they are down to their final few boxes and wish to maximize the value extracted from them. The entire supply chain is beginning to seize up. From the mine to the mint and finally to the retail dealer, the operational gears are grinding to a standstill. Let us reevaluate gold at $4,534. Gold has appreciated by 1.2%, while silver has surged by 10.2%. Silver is outperforming gold by a factor of 10. This exemplifies the high beta effect we have previously forecast. When the precious metals bull market enters its most frenzied phase, silver invariably eclipses gold in terms of performance. Its market capitalization is smaller, its trading volume is tighter, and as a result, it moves with greater velocity. We are observing a dramatic contraction in the gold to silver ratio. At the commencement of this week, the ratio stood above 60. With silver now trading at $79.25, the ratio has fallen into the 50s. Traders meticulously monitor this ratio. As it declines, it attracts momentum traders who specialize in ratio compression strategies. They divest gold to acquire silver, thereby injecting an additional layer of buying pressure into the silver market. Investors are offloading the comparatively more expensive metal to purchase the cheaper alternative, which in turn drives up the price of the latter. This feedback loop is expected to persist until the ratio reverts to historical norms, typically around 30-1 or lower. At a 30-1 ratio, silver would be trading at $150. Therefore, even after experiencing a 10% daily gain, silver continues to represent a compelling value trade. It possesses 100% upside potential simply to align with gold's current valuation. Let us address the issue of margin debt. Numerous retail traders are observing this price chart and contemplating that they have missed the opportunity, viewing the current price as excessively high and considering a short position. Under no circumstances should you short a parabolic price move. The market can sustain irrationality for a significantly longer duration than an individual can remain solvent. Shorting a monetary metal during a currency crisis is akin to professional suicide. But what about entering long positions? Is it prudent to purchase at $79? If you are acquiring physical silver, the answer is yes. You are exchanging depreciating paper for tangible value. If you are trading leveraged paper contracts, the answer is a resounding no. The volatility anticipated for next week will be exceptionally hazardous. We could witness a limit down day where silver plummets by $5, followed by a limit up day where it ascends by $10. If you are trading on margin, you are highly likely to be wiped out by these significant price swings. You may correctly predict the direction of the trend, but you will lose your entire account. Prioritize cash purchases and unleveraged assets. Maintain your safety. We must now discuss the implications of the Monday morning opening, which will occur Sunday night in the United States and Monday morning in Asia. The Shanghai Gold Exchange will be the first to commence trading. They will observe the 10% price surge in New York. What will their reaction be? Will they sell to realize profits, or will they engage in panic buying, recognizing the systemic instability in the Western financial markets? Given the significant industrial demand within China, panic buying appears to be the more probable outcome. Chinese traders are notoriously attracted to momentum. If they witness silver advancing rapidly, they will likely chase it, further driving up the Shanghai premium. If Shanghai opens trading at $85, New York will be compelled to gap up once more. This illustrates the gap strategy. We are transitioning from intraday trading to gap trading, where the most significant price movements occur when the markets are closed. During the trading day, price action tends to consolidate. Overnight, the price effectively teleports. This is a characteristic indicator of institutional accumulation. Large players, often referred to as whales, acquire assets at the opening and closing of the trading sessions. They do not engage in day trading. Let us consider the potential political response. If silver reaches $100 next week, Washington will undoubtedly take notice. They will realize that the transition to green energy technologies has just become approximately 50% more expensive. Solar panels will increase in cost, as will electric vehicles, leading to higher inflation figures. Politicians will likely attribute blame to speculators and hoarders. They may initiate investigations or even threaten price controls. Alternatively, as previously discussed, they might invoke the Defense Production Act to commandeer supply. Any government intervention, regardless of its nature, will serve to amplify the situation, further fueling the price surge. When governments actively target a market, it serves as irrefutable evidence of a genuine shortage. It validates the underlying thesis. Imagine a headline stating, "White House monitors silver market volatility." Such a headline alone could propel silver's price up by $5, as it implicitly signals to the global community that national stockpiles are depleted. Now let us broaden our perspective to the macroeconomic landscape. The 10% surge in silver serves as a powerful signal that the bond market is experiencing severe stress. Bond yields are likely to spike significantly. The US dollar is anticipated to weaken considerably against tangible assets. We are currently witnessing a profound shift, a great rotation. Capital is migrating from the paper-based economy into the hard asset economy. This represents a secular trend, one that unfolds over several years. We observed similar phenomena in the 1970s and again in the 2000s. It is now recurring, but this time the global debt levels are substantially higher and the available supply of commodities is considerably lower. Consequently, the squeeze is poised to be more intense and the price spike more pronounced. We are entering the vertical phase of this market movement. In this phase, traditional technical analysis becomes largely ineffective. Resistance levels lose their significance. Overbought indicators become irrelevant. The sole determinant of price movement will be the flow of capital. Money is entering the market in massive quantities, while physical metal is rapidly exiting. Until this flow of money ceases or a substantial amount of physical metal becomes available, the price is expected to continue its upward trajectory. Observe the volume bars on the trading chart. Today's trading volume was the highest recorded for the entire year. This is a critical validation. The price increased substantially on massive volume, indicating that the upward movement is supported by informed capital or smart money. This was not a low-volume melt-up event, such as what we witnessed on Boxing Day. This was a high-volume confrontation, and the buyers emerged victorious. They systematically absorbed every sell order that the major banks attempted to introduce into the market. This signifies that the available supply has been largely depleted. The path to $80, $90, and $100 is now being paved by empty vaults. What should you do this weekend? Prepare yourself. Prepare for the ensuing media frenzy. Prepare for the extreme volatility. Prepare your mental fortitude. You are now holding a high-value asset. Do not disclose your holdings to friends. Refrain from boasting in social settings. Security should be your paramount concern. Furthermore, develop a well-defined exit strategy. This is not for immediate execution, but for the future. At what point will the market mania become unsustainable? We are not yet at that juncture. We are merely at the beginning. However, you must establish a clear plan. Will you transition your silver holdings into gold at a 30-to-1 ratio? Will you exchange it for land? Document this decision. Create a personal contract with yourself, because when silver reaches $200 and everyone is clamoring to buy, this pre-established plan will be essential to maintaining your sanity. The phrase "it's over" in the title of this commentary refers to the period of market suppression. That suppression has now concluded. The process of price discovery has commenced. The major banks have relinquished their control over the metaphorical beach ball. It is now rocketing toward the surface and is destined to breach it with tremendous force. We are bearing witness to a pivotal moment in financial history, December 27th, 2025, the day the silver market broke free. We are presently experiencing what may be the longest weekend in financial history. It is Saturday, December 27th. The price of silver is frozen on trading screens at $79.25. The broader financial markets are closed. The banks are shut. The physical vaults are secured. However, the pervasive sense of panic remains very much open and active. Across the grand financial hubs of London, New York, and Hong Kong, urgent discussions are currently unfolding within executive suites. Financial risk managers are meticulously examining financial statements, confronting a 10% deficit that has dramatically impacted their balance sheets. They are acutely aware that with the impending market opening on Sunday evening, their organizations might lack the necessary capital to sustain operations. In the third segment of this critical broadcast, we will delve into the systemic vulnerabilities that have been unexpectedly activated. We will elucidate why a 10% fluctuation in a commodity's value transcends a mere trading anomaly. It signifies a significant event for the clearinghouse. Furthermore, we will explore the clandestine transactions being arranged by major industrial players who are bypassing traditional channels to secure vital raw materials. We will also analyze the emerging awareness among the general public whose attention is now being drawn to this situation and how their participation can rapidly diminish available supplies. The existing framework is showing signs of strain, and we will now examine these emerging cracks. Many individuals believe that when they engage in trading silver futures, they are in opposition to a financial institution. However, in reality, their wager is against the clearinghouse itself. The clearinghouse functions as the central counterparty, guaranteeing every transaction and ensuring that the recipient of a trade receives their due, even if the other party defaults. It acts as the ultimate safeguard for the financial system. Yet even this safeguard has its limitations, having been designed to accommodate typical market fluctuations, perhaps 1 or 2% daily, not a dramatic 10% surge within a single trading session. When the price of silver escalates by 10%, the margin obligations for the party incurring losses skyrocket. Imagine a smaller precious metals bank that was short 10 million ounces at $70 per ounce. At $79 per ounce, their deficit amounts to $90 million. The clearinghouse would promptly demand this sum. Should the bank be unable to meet this obligation, the clearinghouse would be compelled to liquidate its assets to cover the debt. However, if the losses exceed the bank's total assets, the clearinghouse would then need to draw upon its default fund, a collective reserve contributed by other financial institutions. This scenario, where an entity like JP Morgan is forced to compensate for the failure of a smaller bank, inevitably leads to friction, causing them to withdraw from trading activities, reduce liquidity, and erode trust in the system. This is what is referred to as a freeze. We are receiving unverified but persistent reports suggesting that at least 2 mid-tier commodity trading firms were declared insolvent by the close of business on Friday. They were adversely affected by this market squeeze. If the exchange officially declares a default on Monday, silver's price will not merely increase, it will become unbid, signifying a complete absence of sellers at any price due to a lack of confidence in counterparties fulfilling their payment obligations. This situation presents the ultimate bullish indicator for physical silver. If the speculative financial markets collapse, the paper assets become worthless, but the actual silver held privately retains its intrinsic value. This concern over counterparty risk is motivating astute investors to demand immediate physical delivery, seeking to remove their holdings from the system before its potential closure. While the financial world grapples with instability, the industrial sector is proactively responding. Companies such as Samsung and Tesla, having witnessed the 10% price increase on Friday, understand its implications. The publicly traded price is no longer representative of reality. Consequently, they are engaging in direct off-market agreements. This weekend, their procurement divisions are traveling to Mexico and Peru, meeting with mining executives to negotiate the purchase of future production. They are offering prices as high as $85 per ounce, with the stipulation that shipments must be delivered directly to their factories, bypassing traditional commodity exchanges. A miner would agree to such terms because $85 per ounce represents a significant premium over the current market price of $79, coupled with a guaranteed buyer. Tesla, in turn, benefits by securing the necessary metal without having to compete for it on the open market. This action effectively privatizes the supply. Silver that would typically be deposited into public warehouses and which underpins exchange-traded funds and futures contracts is now being diverted. This creates a discrepancy between reported supply and actual availability. Official production figures may indicate stability, but the quantity of silver accessible for the public market is diminishing rapidly. This explains the precipitous decline in exchange inventory levels. It is not solely individual investors accumulating silver. It is global industries recognizing the unreliability of public markets and establishing their own private supply chains. Once this silver enters these private channels, it is permanently removed from the public domain, being transformed into components for products such as solar panels, for example, and integrated into long-term infrastructure. Now let us consider the general public, often referred to as uninformed investors. For the past 3 years, silver has been largely overlooked, with public interest focused on cryptocurrencies, technology stocks, and real estate. Silver was perceived as unexciting. However, a review of Google Trends data for this past weekend reveals a 300% surge in searches related to purchasing silver within the preceding 24 hours, with price prediction queries also showing a sharp upward trajectory. The 10% price movement has effectively captured their attention. The average individual tends to follow market momentum rather than intrinsic value. They invest in what is rising. Witnessing a 10% daily gain triggers a fear of missing out, prompting them to access their brokerage accounts or visit local coin dealers. This influx of capital from the general public is largely insensitive to price. This wave of retail interest has not yet fully impacted the market, as it is currently closed. However, retail orders are accumulating with instructions to buy at market open. Thousands of these orders are queuing up within the system. When the market reopens on Sunday night, these orders will be executed simultaneously, creating a significant price gap. Professional traders will be attempting to cover their positions, while the retail crowd seeks to enter, and industrial entities aim to secure their supply, all in the absence of available sellers. This confluence of factors is likely to result in an opening price limit increase. The underlying pressure is immense, and the available supply is extremely limited. We are currently positioned at $79.25, just 75 cents away from the psychologically significant $80 mark. While prices in the 70s might feel relatively high, crossing into the 80s evokes a sense of nearing a $100 valuation. Surpassing $80 will fundamentally alter the prevailing narrative, validating expectations of triple-digit prices. Once the $80 threshold is breached, media coverage will shift from a mere silver rally to a silver frenzy, with headlines moving from "silver up 5% to "Is silver the new Bitcoin?" This narrative shift will attract speculative capital, including day traders, algorithmic trading bots, and leveraged investors, further amplifying price volatility and driving the price towards $85, $90, or even $95, creating a speculative bubble on top of an existing shortage. This bubble, however, can be beneficial for existing holders who acquired silver at lower price points, facilitating a significant wealth transfer. It is crucial to distinguish between the underlying shortage and the subsequent speculative mania. The shortage is projected to drive prices to $100, while the mania could propel them to $200. We are currently transitioning from the shortage phase into the mania phase, with the 10% price surge serving as the definitive signal marking the commencement of this progression. Consequently, the financial system is exhibiting fragility. Industries are aggressively accumulating reserves. The public is becoming increasingly aware, and the price is hovering at the threshold of $80. What will transpire on Sunday night? The Asian markets will open first. Observing the closing prices in the United States and the 10% gain, it is unlikely they will engage in selling. China, being the largest consumer, will likely drive prices upward to secure additional supply. In the fourth and concluding part of this emergency broadcast, I will present a strategic plan for Sunday night, detailing precisely what to monitor as Globex opens. I will reiterate the rules governing price limits to prevent panic during potential trading halts and offer final guidance on managing your emotions during a period of extreme price acceleration. The anticipation is challenging, but the waiting period is nearly over. Please stay tuned for part 4. Preparations are underway for the market opening. We have arrived at the final segment of this emergency broadcast. We have examined the liquidation events that propelled silver to its current level, exposed the risks associated with clearing houses, and documented the panic buying by industrial entities. We have observed the depletion of vault inventories and the disruption of supply chains. Now we find ourselves at the calm center of a significant event. It is Saturday and the markets are quiescent. However, this silence is deceptive, representing the stored energy of a compressed spring poised for release. In less than 36 hours, the Asian markets will commence trading, the electronic futures market, Globex, will become active, and the entire global financial community will be focused on a single commodity, silver. In this final analysis, part 4, I will outline a strategy for Sunday night, detailing precisely what to anticipate when the market reopens. I will explain the limit rules to help you remain calm if trading is temporarily suspended, and I will provide you with the essential psychological fortitude required to navigate what is likely to be the most volatile week in the history of the precious metals market. The existing system is compromised and price discovery has commenced. Let us conclude this examination. Let us engage in a strategic thought experiment. Place yourself in the position of a trader in Shanghai or Tokyo. You have just witnessed the 10% increase in New York's closing price on Friday. You are aware of the desperate need for metal in the United States and the depleted state of vaults in London. When your market opens on Monday morning, what course of action will you take? Will you sell? No. You will preempt the American market by acquiring as much as possible before New York opens on Monday morning. This action will create a price gap. It is highly probable that silver will open at a price significantly higher than $79.25. We could see an opening price of $82 or $85. This price gap poses a risk for traders holding cash, as the price will rapidly accelerate away from them if they delay their purchase. They will be compelled to chase the price, which will further fuel its ascent. However, for those holding silver, this gap serves as validation, confirming that the true value of silver is entirely divorced from its Friday closing price. The market is seeking a price at which sellers are willing to transact. At $79, no one is selling, necessitating a jump to $85 or $90 and continuing to climb until a seller emerges. Now we must address the operational mechanics of the exchange. The CME Group employs circuit breakers, which are regulations designed to prevent excessively rapid market movements. In the silver market, there are daily price limits. If silver's price increases by a predetermined dollar amount from the previous close, the exchange will initiate a limit-up halt. Trading will cease, screens will freeze, and no buy or sell orders will be accepted. The market will be locked. If we experience a price gap upon the Sunday night opening, we could hit this limit-up threshold within minutes. What will be the consequence? Psychological panic. If you are a short seller and the market is halted at a limit-up level, you cannot exit your position. You are trapped in an increasingly precarious situation, knowing that upon reopening, the price will gap up further, guaranteeing additional losses. This compels short sellers to place market on open buy orders for the subsequent trading session, simply seeking an exit. If you observe a trading halt notification on Sunday night, do not be alarmed. It does not signify a price collapse. Rather, it indicates that the price is escalating so rapidly that the automated systems cannot keep pace. This is the most powerful bullish indicator. Remain patient and await the market's reopening. The volatility following a halt is typically extreme, but the upward price trajectory usually persists. Pay close attention to the news headlines on Monday morning. For years, the financial media has largely overlooked silver. On Monday, this will be impossible. A 10% price surge followed by a limit-up opening will be front-page news. However, exercise caution regarding the prevailing narrative. They will characterize it as a speculative bubble or a coordinated retail effort. Experts will be brought in to assert that silver is overvalued. They are misinformed, reading from an outdated script and failing to comprehend the significance of industrial demand, the actions of global consumers, and the depletion of available supplies. Do not allow media pronouncements to deter you. They represent a contrarian signal. When they proclaim a bubble at $80, it suggests we are headed towards $100. Only when they finally capitulate and declare silver the new gold at $200 should we experience concern. Currently, they remain in a state of denial, which is a bullish sentiment. I wish to address you, the individual investor, who has persevered through bear markets and periods of consolidation. You are now on the verge of significant gains, and this success can be challenging. You will observe account balances that exceed your expectations. You will perform calculations, considering the possibility of purchasing a car or paying off your mortgage. The temptation to sell will be extraordinarily strong. However, you must ask yourself a critical question. What am I selling for? Are you exchanging a scarce asset for dollars, the same dollars that are continuously losing purchasing power and being printed to support the bond market? Selling your silver at $80 equates to trading a tangible, limited asset for an intangible, potentially limitless liability. It is akin to abandoning a lifeboat to return to a sinking vessel unless you have an immediate, life-altering need for the capital. Hold your position. We are in a super cycle that spans years, not days. The move from $20 to $50 was merely a prelude. The progression from $50 to $100 represents the initial phase. The subsequent movement from $100 to $500 will be the primary event. Do not divest yourself of your investment before the main event commences. Therefore, the verdict for this momentous weekend is as follows. The financial system fractured on Friday. Paper shorts were liquidated, revealing the underlying physical scarcity. We are entering a phase of price discovery that will be historically significant. Financial institutions have relinquished control. The price is now being determined by industrially motivated buyers and sovereign entities accumulating reserves. $79.25 is not the peak, but rather the breakout point, the moment the beach ball finally breaches the surface of the water. Your strategy for the coming week is straightforward. Observe the Sunday opening, anticipate a price gap, expect trading halts, embrace limit-up occurrences as much as possible, and disregard short-term volatility. $10 price swings will become the new norm. Protect your holdings. Security is paramount. You are witnessing the most substantial wealth transfer of our generation, from paper assets to tangible metals, from debt to equity, from the west to the east. You are positioned at the epicenter, holding the single most crucial asset. Enjoy your weekend and obtain adequate rest, as Monday will usher in a fundamentally changed world. Subscribe.